Good evening, everybody, and thank you for joining me for my How to Buy Masterclass. This is a live Zoom call. It's also being streamed on Facebook, and it will be posted onto YouTube. So depending upon how you're watching and when you're watching, I want to make this as interactive as possible. So for those of you who are live on Zoom, feel free to post your questions into the Zoom chat, and I'll address those as we go. For those of you who are live on Facebook, post those questions. Unfortunately, I can't see the Facebook chat from my Zoom screen, so I'll come back and catch those later. If you're watching on YouTube later on, put them in the comments, and I'm happy to address your questions down the road. So let's go ahead and dive in to what it is we're going to talk about tonight and kind of what the purpose is. So I created this masterclass about 6 months ago, and have been doing this every single month with really the purpose of helping people through the process of buying a home. And whether this is your first time buying a home or whether you've bought multiple homes over the years, the fact of the matter is it's a daunting process. It's a challenge for people who have done it many, many times. It's a challenge for people who have never, ever done it before. And so my goal is to really give you the advice, give you the information necessary in a non-threatening environment that helps to really guide you through the home buying journey. So we start with a little bit about what's going on with the market right now, and then we dive into a topic that I cover, a different topic every single month. So I do these typically late in the month on a Thursday evening, either the third or the fourth Thursday of the month. And then the final part, and there's a different topic every month. And then the final part, I kind of do the same thing, which is to just talk through the home buying process, how it works, what happens, what you need to know on what banks look for, what you need to know about how the process is going to work, what things can be hurdles for you during the process. And we'll take between 60 and 90 minutes to go on this journey and really help give you the information you need to successfully purchase a home. So let's go ahead and dive in and get started with, is now a good time to buy a home? So we are sitting here right now on, what is it, June 22nd, so the second day of summer, and a lot of people are asking that question. And there's a lot of things that we need to look into when we're deciding, is now a good time to buy a home? The first thing that you might want to look into is just simply what the heck has been going on with house prices and what's going on with interest rates. And that's a big factor right now that is really creating a hurdle for a lot of people. So I'll tell you that generally speaking, we're in an environment right now where interest rates are a lot higher than they've been any time over the last 10, 15 years. And it's creating a lot of fear and uncertainty for a lot of home buyers. Matter of fact, a lot of home sellers are afraid to sell their home and buy something else because interest rates are so much higher. And equally, or more importantly, there's very few homes for sale. So what it's creating is a dynamic where if you're thinking about selling your home to buy something else, you're not going to list it for sale because you don't see the home that you'd like to move into listed for sale. The problem is, because you're not listing your home for sale, the guy that was going to buy your home and sell their home as a move up, they're not listing their home either because they're not seeing your home listed for sale. It's a vicious cycle, and it's creating really, really low listings, or the number of homes that are listed for sale. Well, part of that's keeping house prices up, because even though buyers have really gone cold, a lot of buyers right now, honestly, are afraid. They're afraid of where the interest rates are. They're afraid of what's happening with the economy. And I don't blame you if you're feeling that way. Interest rates are high. And a lot of people feel like, man, I shouldn't buy right now while rates are high. I need to wait until interest rates are lower to purchase a home. And that is absolutely a valid thought that I would expect most smart people to have. Here's the problem with that theory. The problem with the theory is there's not enough homes for the number of people that want them. And so you, along with a whole bunch of your friends and family, are waiting until rates come down or prices come down before you buy a home. Well, guess what? The reason house prices have even settled at all is because rates went up. So if house prices come down even more, it's because interest rates went up even higher. And that's not going to help you have a lower monthly payment. So it's not going to save you money if house prices go down. Plus, there's a bunch of cash buyers waiting to purchase homes if they fall. So what will happen is house prices will go down a little bit. A bunch of cash buyers will come in and buy those homes, and prices will jump right back up. So waiting for house prices to fall isn't a good idea. So you say, fine, John, I'll wait until interest rates come down. And that is a fine idea. The problem is when interest rates come down, everybody else you know is going to be looking to purchase a home as well. And it's going to drive up the prices of homes. And it's going to make the competition fierce. And it's going to cost you a lot more money to purchase exactly the same home. Not only are you going to have a higher monthly payment, even though your rate's lower, you're going to have a higher payment because you're buying at a higher price. You've got to have more cash out of your pocket to pay for the down payments. And so it creates a situation where you're actually losing by waiting. So my advice, when people ask me, John, is now a good time to buy a home? First and foremost is, can you afford the payment that it takes today to buy the home that you want? Because the payments are high. The payments are a lot higher than they've been any time in recent history because rates are up and house prices are up. Okay, so if you can't afford the payment, do not buy a home right now. Now, there's some things that I'm going to talk about tonight about affordability. I'm going to talk about exactly this issue and some things you might do to shift your money around so that you can afford it. But if you do the things I'm talking about to shift your money around and you still feel like you can't afford the monthly payment, then you for sure should not buy a home, because failing at owning a home is worse than not owning one at all, because it ruins your credit, it drains your finances, and it's just not a good idea. So my recommendation is, first and foremost, find out if you can afford the monthly payment. Just be careful when you look at online mortgage calculators, because online mortgage calculators don't give you the full picture. Now, my mortgage calculator is built into my app. Later on in this presentation, you'll get a QR code that you can download my app. And when you run the calculation through my mortgage calculator, you're going to get an accurate payment figure. Now, the interest rates change daily. We don't update that rate every day. So we always pick a ballpark standard rate on our calculator that's a little bit higher than average. You can always adjust it a little bit and play with the interest rate. But what's nice is you can get a real idea of what the monthly payment is. By using the calculator that's in my mobile app, you download it to your phone, you can pull it up at any time you want and look at a particular purchase price with a particular down payment amount, and it'll tell you the total payment, including property taxes, including homeowners insurance, and including mortgage insurance. So the key is have the right figure for how much your monthly payment is going to be, and then determine if you can afford that payment. If you can, then you're in really good shape to buy today. Why? Because when interest rates fall, you can refinance to get a lower payment, but you don't have to worry about paying a higher price for the home. You've locked in today's price. That's really the biggest key to succeeding in playing the timing game in the market right now. Is buying now is going to save you money. Because even if you spend an extra $500 a month for the next 2 years, okay, so that means that you've spent $12,000 more in monthly payments over the next 2 years than what you might have spent if interest rates were lower. But you got to think to yourself, how much higher would the home sell for if in 2 years from now rates have dropped from 6.75 to 4.75? You think the price would be higher than 12 grand more than what you paid for it? I feel pretty confident it will. So do you pay an extra $12,000 for the next 2 years, or do you pay an extra $30,000 for that same home 2 years from now? That's really the key that I look at when I help people understand whether it's the right time to buy. Can you afford the monthly payment, even though it's higher than what you might like? And then how much money is it costing you compared to how much would it save you down the road once everybody else jumps into the frenzy as interest rates come down? So that's pretty much a basic overview of what I see in the market today. I definitely see more buyers starting to come back into the hunt, because we saw interest rates shoot up a year ago and people kind of said, okay, well, either house prices are going to fall or rates are going to come back down. And neither one has happened. And people postponed buying. A lot of people even sold a home. I talked to a guy today that sold his home a year ago. And he said, he was asking me questions about what's going to happen with the market. And I said, there's people who sold their home a year ago and they've been waiting. And now they're finally saying, what am I waiting for? There's nothing that's going to happen to save me money. And he goes, it's funny, John, You're talking about me. I sold my home a year ago. So we're seeing more people starting to say, I'm tired of waiting and hoping something's going to get better. It's not. What will get better is if you buy a home and then you can refinance to lower your interest rate in a few years. The question is, when are rates going to come down? That's the $1 million question. If I knew that, I wouldn't be sitting here on the Zoom call today, because that's really about predicting the future. We can predict market cycles. We can predict economic cycles. We can look at patterns and say, yes, interest rates right now are near their peak. I don't think they're going to go much higher. I think they're going to stay in this range, and we're going to see rates between 6 and 7.5%, like we have seen for the last 6 months, until something significant changes. And then we're going to see the cycle of interest rates start coming back down again. How far down they'll go, we don't know. How quickly they'll go down, we don't know. When is that going to happen? Guess what? We don't know. But here's the most important thing we do know. It's a cycle, and it repeats itself over and over again. And so if you get in now, you've got the opportunity to take advantage of that cycle later. All right, so let's dive into the topic. Oh, I think I somehow muted myself. Anyway, hopefully I haven't been muted for very long. All right, so let's dive into the topic that I want to cover today. And that topic is specifically regarding, hold on a second, I just lost, there you are. Okay, cool. So that topic is specifically regarding the hurdles to buying a home. What are the challenges that people are running into in trying to buy a home, and how can you overcome those hurdles? The two biggest hurdles are really, really simple, which is, John, I don't have money for a down payment is hurdle number one. And hurdle number two is I just can't afford the monthly payment. And we've been talking about that for the last 10 minutes about monthly payment being a major component of your ability to buy a home today. Because again, you're not going to have a lower house payment than you're paying in rent. Those days don't exist right now. Inflation has gone up, rents have gone up, but with interest rates as high as they are, it is rare that you're going to find a situation where you're going to pay less money for a house payment than you pay in rent. So you've got to be prepared to invest in home ownership, invest some money into your future wealth by becoming a homeowner and being willing to set aside some of the money you were saving somewhere else or for something else, and instead set it aside and making a higher mortgage payment. So let's talk about these things specifically. First of all, when we talk about money needed to purchase a home, what you're really looking at is two very, very important things. The first thing you're looking at is how much do I need for down payments? Okay, so your down payment can be anywhere from 0 down payment for a VA or USDA loan to 3% down for a conventional loan to 3.5% down for an FHA loan. Now, if you are not a first-time home buyer and you're doing a conventional loan, you actually have to put 5% down. But most people misunderstand, and they think you have to put a bigger down payment for a conventional loan, and they think FHA is the cheapest down. It really, really isn't. So the down payment itself can come only from 3 places. It can come from your money, it can come from a gift, or it can come from a down payment assistance program. But on top of your down payment, you've got to pay closing costs. Now, closing costs average 3% of the purchase price. I say average, sometimes a little bit lower, sometimes a little bit higher. I'd say it's fair to say $10,000 to $15,000 is a reasonable average. Now, you're not going to spend $30,000 in closing costs on $1 million purchase, but you might spend 20, might be 2%. But if you're buying a $200,000 home, it's not going to be $6,000. It's going to be closer to 10. So realistically, 3% is a good ballpark, but you're looking at $10,000 to $15,000 on average. It's rarely less than 10 grand because you've got a lot of things that go into the closing costs. Matter of fact, last month on my How to Buy Masterclass, I specifically talked about all of the things that go into your closing costs. So you can check that out in my YouTube library. If you're looking for information on what actually constitutes your closing costs, you can find that information in my YouTube library. But here's the deal. Closing costs can be paid for by the same 3 places that you can pay for down payment, which is your money, gift money, or a down payment assistance program. You can also get a seller credit to pay for closing costs or a lender credit to pay for closing costs. Now, seller credits, that typically means the seller would have been willing to sell you the house for less, but instead you're buying the house for a higher price. and taking the discount in closing costs. It's kind of like buying a car and the car dealer says, you know what, I'll sell you that car at full price and I'll throw in upgraded, whatever, an upgraded stereo, and I'll throw in an upgraded tires and rims and the paint protection package. Well, they're not really selling it to you for full price, but they get to say they sold it for full price, which is the same thing a seller wants to be able to do. Now, if there's somebody else willing to pay full price for that car that doesn't want new tires and new rims and a new stereo and the paint protection package, the dealer's going to sell it to them, not you. But if nobody else wants to buy that car at that price, they'd rather sell it to you at the full price and give you a credit than to lower their price. It makes them look better to their bosses. And in the idea of selling a home, the homeowner gets to feel like they got their full price. They can tell their friends, hey, I listed my house and I got full price for the home. So it can make a really big difference emotionally to ask for a seller credit instead of a decrease in the price of the home. Just be careful, because sellers are very emotional. So this is the part where I'm talking about strategy, and this is about having a really good real estate agent that can help you determine what the right strategy is to purchase a home. And strategy with sellers it's often not about the dollars, it's about how dare they mentality. So a seller is going to say, you know what, I'm listing my house for $500,000 and I think it's worth $525,000, but my realtor beat me up and told me to list it for $500,000. Now you think it's worth $480,000. But if you say, hey, Mr. Seller, I'll lower the price to $490,000 and I'll give you a $10,000 credit for as long as you give me a $10,000 credit for closing costs, I'll buy your house for $490,000. The seller's going to say, oh my God, how dare that buyer insult me with a low ball price and ask me to pay their closing costs? How dare they? That's where you got to be careful. Sometimes the seller is going to be happier saying, look, a price cut's a price cut. So if you lower the price and you say, hey, I'm going to offer you $480,000, they're losing $20,000. Are they really losing it? They never had it. But in their mind, they're losing another $20,000. That's just a dollar figure, but you're impacting them only in one way, which is you're lowering the price. But if you ask them to lower the price and give you a closing cost credit, even if it was only $10,000 in a lower price and $10,000 in a closing cost credit, instead of $20,000 off the price, the seller doesn't feel that way. And they're going to stick their heels in and say, nope, I'll wait for another buyer. Now, I'm not telling you that what I'm describing happens every single time. I'm telling you these are the things of why it's critical to have a good realtor to help guide you. Because the realtor is going to be able to see what other homes have sold for. They're able to see how long this house has been on the market. They know what they would be saying to their seller if they were representing the seller in the home. And that's something you as a home buyer don't automatically know. You don't have the experience or the history of having done that. And so it really makes a difference having a great real estate agent on your side. Now, what's a lender credit? A lender credit is you paying a higher interest rates every single month, a higher monthly payment in order for the seller to have paid some of your closing costs. There's some situations where we can do that right now, but it's not as prominent as it used to be. It's not as prominent as it is in a low rate environment, because the banking world understands that you're likely to refinance this loan pretty soon anyway, because they expect interest rates to go down also. And so why in the world would they give you a lender credit? Well, because they expect to make back that money over time. But if rates right now are at 6.75 and you said, well, I want you to pay 2% of my fees. And the bank says, okay, well, then I'm going to charge you 7.5%. So I'm charging you an extra 0.75% per year. For 30 years, they're going to make over 30 years, they're going to make a bunch of extra money. But they got to run a break-even calculation and say, well, wait a second. If I give you 2% right now, and I get an extra 0.75% every year, it's going to take 2.5 to 3 years of you keeping this loan before that extra 0.75% in interest you've paid me covers the 2% that I gave you up front. Do I think you're going to keep this loan for 2.5 to 3 years? Well, if rates were at 6.75, there's a better chance you're going to keep it because rates, you're at least a little bit lower rate, but at 7.5, it's a higher chance you're going to refinance. So it's really a bad thing for banks to give you lender credits in this environment. So just be aware, this is a concept that can happen, but it's not as common when rates are up because the bank is worried you're going to refinance anyway, and they're never going to make back the money that they covered up front for closing costs for you. All right. So now that we've talked about what are the monies you need up front, now let's talk about how do we overcome the lack of down payment? That's one of the biggest things I'm hearing about is, John, I don't have money for a down payment. Well, first of all, the first place I think you should go is the bank of mom and dad, or auntie and uncle, or brother and sister. Go check with family. See if somebody in your family is willing to help you with a down payment. Because although we have down payment assistance programs, and I'll talk about those in a couple of minutes, the fact is almost all of the down payment assistance programs come at a cost. And that cost is going to be in a higher interest rate. It's going to be in a higher monthly payment. It's going to be in higher fees than what you would pay if you didn't take advantage of down payment assistance. So getting money from family might come with a high emotional cost, but usually it comes with a much lower financial cost. So you simply have to decide, well, am I willing to put up with mom and dad telling me for the rest of my life that I wouldn't have this house if it wasn't for them? Well, that's a pretty high emotional cost. The question is, what's that worth versus what the physical cost is, what the financial cost is, and can we make it work? So that's really important as an idea to get a gift from family. The other ideas that I've got, look, I think as a society, as an economy, especially over the last few years, we've kind of gotten spoiled with toys. We kept getting pay raises, yet our shelter costs weren't going up anywhere near as quickly as our pay raises were. We got a bunch of money given to us during COVID, and we weren't spending any of it because we weren't going anywhere. And so we started buying toys. And I think we ended up in a position where we ran out of the free money the government was giving us. And yet as a society, we kept buying toys because we were used to it. And so we run up our credit cards, we've got now payments on boats and jet skis and a second car. Well, all that's great, but those are depreciating assets. Those are things that typically lose money over time. A home is an appreciating asset. That means the prices are going up on a regular basis. So think about selling some of those things. Think about making a decision to say, you know what? I can buy those again when interest rates come down and I can lower my monthly payment. But for now, I need to take advantage of the opportunity. So if you don't have a down payment, maybe you sell those things and you get those assets back. You sell that boat and you get the money the boat's worth to use towards your down payment. Maybe you take a withdrawal or a loan from your 401k. I'm going to talk a little bit later about the financial benefits of owning a home. But let me tell you, you make more money on average in home ownership, significantly more return on investment on home ownership than just about any other investment you're making. And that includes your 401k. Now, your 401k is a close second. It pays really, really well because it's tax-free growth. And oftentimes your employer is participating, but maybe you take a loan against it, or maybe you take a withdrawal. I can help guide you through those thoughts. But if you don't have money for a down payment and that's what's stopping you, look at maybe you take some of the wealth that you've built in this bucket and cash it in so that you can build wealth in another bucket that historically has grown significantly faster and exponentially more. Because if you have $40,000 in your 401k and your 401k goes up by 20%, you've made $8,000. But if you take that $40,000 and you put it as a down payment on a $400,000 home, and now that $400,000 home, it only goes up by 10%. You've made $40,000. You've literally doubled your money because you took $40,000 out of your IRA or your 401k, and you bought a $400,000 home that went up by 10%. Now, the average appreciation is about 3 to 4% per year, but let's just pretend it only went up 2% per year. In 5 years, you will have made 10% increase in the value of that $400,000 home. That's 40 grand. That's double the money that you would have made, that you gave up on your 401k. Your 401k literally would have had to grow by 100% during that time in order to make the same amount of money. So it's important to understand the dynamics of investing. Now, I'm not giving investment advice, but I'm giving math advice. Okay, making 10% on 400,000 is better than making 20% on 40 grand. That's just math. So it's important to understand that concept, that maybe pulling money out of your 401k might be, I'm not telling you it's a good idea, but it might be a better idea than not being a homeowner. All right. What about a low down payment loan? So I mentioned that conventional loans require as little as 3% down, FHA is 3.5% down, but if you're a veteran, VA loan's a great option. If you're not a veteran, you can do a USDA loan. Now there's geographic restrictions. You have to buy within a certain geography outside of big cities, but there's a lot of opportunities within California and nationwide for USDA loans, and they are 0 down payments. But there's a new program I'm going to introduce to you tonight that is a 1% down payment loan. It can be used anywhere in the United States, but there are some pretty particular rules. So I'm going to talk to you in a couple minutes about what the rules are for the 1% down program and how that can work and might work for you or for somebody that you know. And the final thing to overcome a lack of down payment is down payment assistance. Just recognize it's not free money. Everybody thinks, oh my gosh, if I get down payment assistance, I'll go get a grant and that'll cover my down payment. There are very few grant programs out there. Matter of fact, there's one right now. It really is a great program. It is the California Association of Realtors Housing Affordability Fund. And they will give you a grant. You never have to pay it back. It doesn't change your mortgage at all. You don't pay a higher interest rate, nothing. But you have to meet certain rules. You have to make under a certain amount of income. You must be a first-time home buyer. You must meet one of 3 categories of underserved communities. You need to either be a person of color, you need to have a disability, whether it be physical, mental, or cognitive, and you need to be a member of the LGBTQ plus community. So if you meet those criteria and they still have money, you can get a $10,000 grant to pay some towards your closing costs that you never have to pay back. Matter of fact, I have a client closing escrow in 2 weeks that took advantage of that program. We got the money reserved for him and he's getting his free, it really is free, $10,000 grant. So there are options that are free. That's the only one that I know of right now. The rest of them cost you more money. You're paying higher interest rates, you're paying higher fees, you're paying higher monthly payments than if you had your own down payments. So lots of options for down payment assistance, and only some of them require you to be a first-time home buyer. There's lots of programs out there that I have access to that do not require you to be a first-time home buyer. So if you're thinking, hey, I can't use down payment assistance because I've owned a home before. First of all, the definition of first-time home buyer resets after 3 years. Once you haven't owned your primary home for 3 years, you're considered a first-time home buyer again. That's really good news for a lot of people that they don't understand. But secondly, even if you did own your primary residence in the last 3 years, there are lots of down payment assistance options that don't require you to be a first-time home buyer. So don't exclude yourself from being able to qualify because, well, John, none of these things work and I'm not a first-time home buyer, so I can't get down payment assistance. That just isn't true. All right, so now that we've talked about how to overcome the issue with a lack of down payment, the second issue we talked about is how to overcome the issue of affordability. It's a big, big challenge right now is how do I afford to make the monthly payment because these interest rates are high? I just can't make it work. Well, as I said at the beginning, do not buy a home if you cannot find a way to make the monthly payment work. But what I'll tell you is don't automatically say I'm not going to buy a home simply because the monthly payment is going to be higher than what you want it to be. I want a lot of things. I want a Lamborghini, but I can't afford it. So we got to be careful about what we want versus what we have to do in order to get what we want long-term, short-term versus long-term. So 5 things I talked about. First of all, sell your toys. Now, I feel like I said this already. Now, I was saying that as far as sell your toys and get the cash from it to put towards down payment. How about the monthly payment you're making on those toys? I see people that have 2 and 3 and 4 cars or a couple of boats or a boat and a jet ski. That's great. And I'm not saying that you become house poor and that you don't enjoy life. I'm not saying any of that, but I am saying, hey, how much life enjoyment have you done? And when is it time to say, hey, I'm going to shift my priorities a little bit. I'm going to shift my priorities until interest rates come back down and I can afford to put that money back towards those toys. And maybe for a few years, I'll do some staycations. I'll enjoy the nice pool. I'll make sure I'll get a backyard that has a pool, which brings up a really important point. With the fact that there's very little inventory right now, you have to very much understand what is the list of the things you must have in a home versus the things that would be nice to have. And if you can get 90% of the must-haves and 1 or 2 of the nice-to-haves, that's beautiful. Don't make the mistake of saying, nope, I'm not going to settle. I'm going to buy the perfect house. The problem is you'll never buy, and prices will keep going up. And you're going to end up feeling like, man, I should have bought back then, because if I bought a home back then, I could have traded it up for a bigger home. I could have traded it up for my right home, because let's be clear. Most of the homes that you're renting aren't your perfect home either. So don't get in the position that says, I got to have the perfect house and it's got to meet all my boxes. Otherwise, I'm not going to do it because I don't want to regret buying a home. Life's not perfect. And so you have to take a risk. You have to move forward and jump into something that may not be exactly what you're looking for. So get your list of must-haves and make sure it's must-haves. And even at that, if you can get 90% of your must-haves, there's a chance you'll never find 100% of your must-haves. But oftentimes you can modify the property over time to give it the rest of those must-haves. The only thing you can't do is move the property. So be careful about buying in the wrong location, because you might say, oh, I'm okay with a 2-hour commute to work. You are for now, but after you start paying for the gas and spend all that time in the car and spending no time with your family, a lot of people, that's their biggest regret, is location. You can change almost anything about a house. You just can't pick it up and move it. Now, you can sell it and buy something else, but then you got a lot of costs associated with it that wouldn't be necessary if you paid more attention to location. When I say cost, you have costs to sell the home, costs to buy the home. So pay attention to the location as one of the must-haves, or at least an important must-have as far as geography. A lot of other things can be changed over time. All right, so sell your toys. Here's another one, gang, get a roommate. Now, I might not be able to count, I can't count the income from your roommate, but it's still about affordability. So when we sit down, and I'll talk later about how the process goes when we sit down and qualify you, but when we sit down, I'm going to look at what I will let you spend. And then you're going to tell me what you're willing to spend. What I'm finding most of the time is people are willing to spend less than what I would let them spend. Now, I'm totally okay with that. I don't know how much money you spend in eating out or traveling or sports or anything else. I have no idea. We don't take that into account. So I understand the concept of having a life and not being house poor. But that's where getting a roommate comes in. That's where, hey, if I rent out one of my rooms, then, or maybe I convert the garage into a livable unit. Maybe I put an ADU, an accessory dwelling unit, on the property so that I can create rental income. Now I can use that income to offset the monthly payment. Now, most of the time for qualification, I can't count that roommate's income, but I can give you, it does give you the comfort that says, hey, John says I can afford $4,000 a month, but I only want to spend $3,000. Well, if I got a roommate that's paying me $1,000 a month, then really my $4,000 house payment only feels like $3,000. Just be prepared, because if the roommate moves out, you're on the hook for the entire $4,000. But it's a great strategy because you can replace the roommate, put somebody else in there. Maybe rents have gone up and you can get $1,200 a month. It's really, really a good strategy. Buy a multifamily property. So funny, when I say multifamily, there's 2 things that I want you to think about. First of all is literally multifamily is a 2, 3, or 4 unit property. But for some people, buying a multifamily property isn't having a 2 or 3 or 4 unit property. It's putting multiple families in the same property. Now, I'm not necessarily, don't be confused. This is kind of a hybrid, because it's kind of like getting a roommate, except the roommate is your adult child or your cousin or your sister or brother or your aunt or uncle, and you're buying a home with them. You guys split the house payment. You guys live in the house together. And then in a few years, when house prices go up and interest rates come down, one of you buys out the other one. You refinance, and whatever the equity is or how much the house price has gone up, you split it in half. Half that money you pay out to the person who's moving out. Now they have a chunk of cash that they can use to put a down payment on their next home. So buying with family is a great option if you can stand living with your family. So that's a great way to overcome payment affordability, is to buy with family. Now, buying a multifamily property means you're buying a duplex, a triplex, a fourplex. Now, I got to tell you, there's some cool loan programs out there. I've got a program that allows you to buy a multifamily property with just 5% down as long as you're going to live in it. And there's even some options for down payment assistance to cover some or all of that 5% down payment. So it's a really good option because now you have rental income coming in, and I get to count that rental income in your qualifications, because a multifamily property is a completely separate unit, different than putting a roommate into the house that you're in. Roommates, they come and go. And it's, if you don't have the right person as a roommate, you might not replace that roommate with somebody else. But if you've got a whole nother house that's connected right next door and the tenant moves out, darn sure you're going to replace that tenant. You're going to put somebody else in there. So I get to count that income towards your ability to qualify for the mortgage. It's a really, really good option to help you purchase a home that you're worried about payment affordability. Spread out the payment. Let your tenants move in the units that are connected to yours. You get all of the tax write-off. You get all of the money for the appreciation of the home. You get the money that goes into the forced savings account that I'll talk about in a few minutes. Yet they're the ones that are paying half to 2/3 of the monthly payments. So it creates a great opportunity for you to purchase a home that you don't have to worry about bearing that entire monthly payment on your own. Now, the fourth thing is decrease the amount you have going to savings right now. I talked to you earlier about pulling money out of your 401k. And the idea being that you're going to make more money over time by having your money, by owning a home, than you would having the money in a 401k. Well, what about slowing down your 401k payments or contributions? That's the word. Contributions is the word. How about slowing down your 401k contributions? How about slowing down how much you're contributing to your savings account or to your stocks or to your money market, because you're going to build a savings nest egg in the equity in your home. So you're not stopping saving, you're shifting where that savings is going. So if you're putting $300 a month into contributions to different savings programs, maybe you stop doing that and now you have an extra $300. Lo and behold, that $300 can help you afford the higher monthly payment. And then when rates come back down and you're able to refinance, you save that $300 off your monthly payment. Now you start contributing that money into that savings program again. Now you have the best of both worlds because you're building equity in your primary home and you're back to contributing into that savings program. So it's about what's the most important use of my money today. And sometimes that can change based on what your long-term strategy is. The final way that I have an idea of overcoming payment affordability issues is to change your withholdings on your paycheck. So, okay, when you're owning a home, you get a tax write-off you didn't get before. You're going to get more money back at the end of the year. But waiting until the end of the year to get the money back doesn't help you with that monthly payment. But changing the withholdings on your paycheck can. Now be careful, talk to your tax advisor. I'm not a tax expert. I don't pretend to be one, so I can't give you tax advice. But I can tell you this is a great option to help you be able to make a monthly payment that is higher than what you thought you were going to be able to afford. All right, so let's talk about this 1% down payment option. I talked earlier about this being an amazing new program, and I want to discuss it with you and really walk through what are the details of this 1% down option. Now, the first thing is it's a 1% down payment from you, but you can put as much as 2.99% down. So if you said, you know what, John, I want to put more down, you can, but not a lot more. Now, if you're buying a manufactured home, you can actually use this program. You must put 3% exactly of the purchase price, no more, no less. And then you get 2% a grant from the lender. So if you're putting 1% down, they're putting the other 2% down, and therefore you're putting 3% down. That's the minimum required for a conventional loan. So you have the opportunity. Now, I said earlier that for a conventional loan, you have to be a first-time homebuyer to put 3% down, but that's not true on this program. Matter of fact, not only do you not need to be a first-time homebuyer to put 3% down, with this program, you're putting 1% down, and you're still qualifying for this program, even with not being a first-time homebuyer. Now, this program mandates a 620 credit score. So I said 620 is required, but this is a Fannie Mae loan. Fannie Mae makes the rules. They have a computer system that evaluates you. And when you have a 620 or 640 credit score, and you're only putting 3% down, yes, you're putting 3% down because it's your 1% plus the grant of 2%. Fannie Mae's system rarely is going to like you. Now, it's not going to put that anywhere in writing. In writing, it says you have to have a 620 credit score, but the computer system is tweaked all the time. It's an algorithm that looks at payment history and risk factors, and Fannie Mae has been tightening that box, tightening that equation. And so I'm finding anecdotally that you really need a 680 or better credit score in most cases in order for the AUS, or automated underwriting system, to approve you. Now, I can say everything looks good, but until I run it through Fannie Mae's system, you're not approved. And so it's critical to understand that, yes, the rules say 620, but history, experience says you probably want to be closer to around 680 or better. That is not a hard and fast number, but it's up to the computer to decide who qualifies and for what amount. Now, there's a couple of things that are challenges here. The first challenge is this program has a maximum loan amount of $350,000. So if you're buying in 3/4 of California, you're going to say, John, I can't find anything for $350,000. I understand that. So this program is not made for you. You can still do a 3% down conventional loan. You can still do down payment assistance, where you have assistance from the state of California, and you can buy a $800,000 home using down payment assistance. I helped a client a couple months ago use the California Dream for All program. They bought a $1.25 million home, and they got $240,000 from the state for down payment assistance. Now, that program has run out of money. It's going to come back. And so if you're interested in that program, or once we do a consultation and you realize, you know what, the only way I can afford to buy a home is using the Dream for All program, no problem. We'll wait until that program is launched. But realize that program ran out of money in 8 business days. It's going to run out even faster next time. So there's going to be fierce competition. I mean, fierce competition to get an offer accepted right away once that program's released. Well, fierce competition equals higher prices, because if buyers are competing fiercely to get their offer accepted, it means they're offering higher prices and you're going to pay more for the home. So if you can qualify without Dream for All, you should. But if the only way you can qualify, or the only way you can afford the payment, is using Dream for All, go for it. I'll be here to help you make it happen. It's just going to take really, really good timing. And if that's your strategy, your must-have list needs to be really, really tiny, because you can't be very picky when you might have one weekend to find a home. And if you don't get your offer accepted that weekend, there's a chance it's going to run out of money and you're not going to have the option for Dream for All for another year. And imagine how much more prices are going to go up in that year, and it's still going to go out pretty quickly. So if you want to use Dream for All, you need to talk to me now to get qualified so that we know you're ready. And then you need to be making your list of what is must have on the home, and it needs to be super small because you're not going to have a lot of opportunity to shop. All right, so $350 is the maximum loan amount. The second thing is you must earn under 80% of the area median income. So there's a tool. As a matter of fact, I can show you right now. Let's see here. Let's go to the right here. Let's share that. And this is the Fannie Mae AMI lookup. And when you go to the Fannie Mae AMI lookup, you will see you can put in any address you want. And that address is going to be, so I will put in, I'll just put in a city. I'll put in Stockton, California. Oops, I got to hit OK first. Okay, so if I put in Stockton, California, and what it's going to do is it's going to show me what is the median income. And it says, hey, the area median income is 100,300. If you've ever looked this up before, these numbers are updated once a year in early June. And guess what? It is late June. So these numbers were just updated within the last 2 weeks. And so it says, hey, if the area median income is $100,000, then to be able to use this assistance program in San Joaquin County, you have to make a family income of less than $80,240. Now, you'd say, well, John, I make more money, but I want to buy in a more expensive neighborhood. I want to buy in San Francisco. And so what's the income limit in San Francisco? Well, the good news is San Francisco, you can make up to $126,000 and you can qualify. The problem is there's no houses under $350,000 in San Francisco. So it's not a viable option in high cost areas. But let's pretend that you're buying in Pioneer. So Pioneer is a city up in the foothills of California. And if you're buying a house in Pioneer, it says, hey, you can make $80,960. And this is based on where you're buying. So if you live in San Francisco and you're going to buy in Valley Springs. So Valley Springs is a city about 30 minutes east of Stockton up the hill. In Valley Springs, you can make $77,000 a year and use this program. And you can probably find up in the foothills something for under $350,000. There's not a lot, but they exist. And so if you're willing to move, maybe you move from a higher priced area to a lower priced area. As long as you meet the income threshold of the area you're moving to, then you're fine. So this is a great option. You just have to make under 80% of the area median income. Those are the only two negatives. Maximum loan amount of $350,000. You must earn 80% or less of the area median income. But here's the best part. You have no monthly mortgage insurance payment, no mortgage insurance at all. This program, the program is offering the 2% grant and it's paying for your mortgage insurance. So you make no mortgage insurance payment at all. Like seriously, you're never paying mortgage insurance and you're literally putting 1% down. That saves you between, you're probably looking at between $250 and $400 a month that's going to save you compared to buying a $350,000 home, putting 3% down, and the mortgage insurance you would have to pay, depending upon your credit score and your debt to income ratio, that mortgage insurance is $150 to $400 a month. So it is a significant amount of savings on this program because you're not paying any mortgage insurance. All right, so I got my first question. Thankfully, the people who are watching on Zoom, I know now that you're alive, so I appreciate you guys posting that question. So Jose asks me, how do they base the income? On current pay rate or last year's tax returns? So it's a little bit of both. It's a little bit of magic. What's happening is we're looking at what we call qualifying income. Qualifying income is the income I'm using to qualify you for the mortgage. Now, I don't look at what you made last year and say, okay, well, that's what you're going to make again. Because maybe last year you got a bonus, a hiring bonus, a one-time bonus, and that's not going to continue. Maybe last year you made a bunch of overtime, but your overtime is decreasing now and you're not making as much. Or your employer says, we're not going to be working as much overtime anymore. And so we don't count the overtime. Maybe you got a pay raise. So maybe last year you started halfway through the year, and here we are, you just hit your 1-year anniversary and your pay went up significantly. I will count your pay based on the pay raise. Now, there's some ways I can get creative. Maybe you got a pay raise, but you qualified even before the pay raise. I don't have to tell them you got the pay raise. So there's some ways in which I can help you, but you have to qualify for the mortgage with the same income that we're looking at for saying, are you under the 80% number? And so it's really my evaluation of how I'm calculating your income. And there is no one simple answer, Jose. It's not just your current pay rate. It's not just last year. It's essentially what the mortgage industry looks at, and I'll talk about in a couple of minutes, but this will give us a head start on it. And so when we're looking at your pay, we're trying to predict the future based on what's happened over the last 2 years and what we expect to happen over the next 3. And so there's a lot of variables that come into that, and I'm an expert on how to navigate those numbers. And there's times when I can look at it a little bit different. Then maybe we want to be less aggressive in order for you to be under that 80% number. And there's ways we can make that work. So hopefully that helps answer your question, Jose. Anybody else, especially on Zoom, let me know if you have questions. Feel free to post into chat. It just reminds me that you're here and you're listening and I haven't put you to sleep. All right. So let's look at the numbers for the 1% down program. Now, remember, I told you earlier, you've got down payment and then you have closing costs. So let's talk about what this looks like in numbers. So if you did the 1% down with you paying the normal closing costs, so you're going to get a rate in the high 6s, you're paying 1 point or 1% of your loan amount for that interest rate. Your payment's about $2,700 a month, and you're coming in with about $17,000 out of pocket for your 1% down plus your closing costs. And you say, whoa, John, hold on a minute. You said 1% down and buying a $350,000 home. 1% is $3,500. There's always a trick, and you tricked me, John, because you're telling me 1% down, and now you want an extra, $12,000, $13,000 on top of that. Well, because of the closing costs, but there's other options. So let's look at door number 2. We can bump the interest rate a little bit. This is where I said you could get a lender credit. You can decrease your closing costs by increasing your interest rate. So you save 1% off of your fees. So it's $3,400 less expensive in upfront costs. Now, it still doesn't get you close to the numbers you're looking for. I'll show you how to do that in a second. But what you're trading off is you're trading off a payment of $145 a month more. So you have to decide, can I come up with the money myself, or should I pay the extra $145 a month? It's a trade-off. The final piece, this is really door number 3. This is the option that allows you to buy with 1% down and really only have 1%. And that's by getting a seller credit. So if we use this less fee option, so we got a little bit higher of an interest rate, so your payment's $2,840, but you get a 3% credit from the seller. That 3% seller credit is about $10,000. So now, instead of paying $13,000, you're only paying $3,000. So $3,500. So that's how you truly buy a $350,000 home with only 1% out of pocket. You've got to have the seller willing to give you a seller credit of 3%, or in this case, approximately $10,000, and you truly can buy a home with $3,500 out of pocket. It is an absolutely amazing program. Speaking of amazing programs, there's one last thing I want to talk about before I talk about just the home buying process and how all of that works. And that is, there's another assistance program. There's multiple programs out there, but the one that I want to talk about that people don't really understand is there's some grant options that aren't just free money. They're tied to, you're going to pay a little bit higher interest rate on the loan. You're going to pay a little bit higher fees, but there's some special grant options for people that are medical and healthcare workers, people who are law enforcement or firefighters, education, work in education, including school staff members, or there's a really special program for people who are county or employees of these counties. Now, it does not mean you are working in the county. It means you work for the county. Like your paycheck says County of Alpine as your employer. So take a look at this list, go back in the video and replay it. I'm not going to read through all the names, but there are, if you are a county employee, then you can check this list, or you can email me and say, hey, John, I work for one of these counties in California. This is a California only program. And is my county, is my employer one of those that gives us the extra special grant program? All right, so let's shift into the big picture of how does this process work of buying a home? What do banks look for? What do I need to know? So there are 3 keys of what banks look for. The first key is cash. Cash is the amount of money you have for down payment and closing costs. Sometimes they also want to see money for reserves. Reserves being extra money that you have in the bank after paying your down payment and your closing costs. Reserves are for things like rainy day fund because something breaks in the house and you got to fix it. Lots of different things. What I'll tell you is reserves are very rarely needed in the mortgage world to qualify you. But it is by far my feeling is it is the single most important factor for success in home ownership is having money in reserves. So that you are prepared if something comes up and it starts raining. So if you use all of your money to buy a home, okay, but that means your first thing after you buy the home and you start having some disposable income is you rebuild your savings account. You rebuild your reserve account, ideally to have at least 3 months of your expenses in that account. That is critical to success. Things happen. You don't want to lose your home. You don't want to lose your credit because you were out of work for a couple of weeks or something strange happened. So cash, down payment, and closing costs, reserves are important to me, but they're not very important to the mortgage industry. Credit's the second thing we look at because how well you've paid your bills in the past is the best indicator of how well you're going to pay them in the future. Now, you got to be careful about credit because what you see on Credit Karma is a different number than what the mortgage industry uses. Now, if you see your Credit Karma number go up, then it's likely my number is going up. If you see Credit Karma going down, it's likely my number is going down. The only way you can see the mortgage credit score that I know of is to go to myfico.com, and you have to pay a fee to sign up for their service. But then once you're in there, it gives you all the different versions of credit scores, including your mortgage credit score. So if you want to see in advance what your credit is, go to myfico.com, subscribe to it, look at the mortgage credit score. But I got an easier way. We can do a soft credit pull. That means it doesn't cost you anything. It doesn't impact your credit score. It doesn't show up as an inquiry on your credit report, but I can take a sneak peek behind the curtain and see what your credit looks like. And so it's really, really important that credit is looked at and it's looked at early because people think they have credit problems that they may not have as bad as what they think. People think their credit's perfect and there's issues they didn't even know about. So if you're making a decision on buying a home and you haven't looked at what your mortgage credit is, you're flying blind. And I don't care how good you think your credit is. It doesn't cost anything to have me do a soft credit pull or sign up for MyFICO and just find out what your score is. It's one of the biggest mistakes I see people make is assuming it's great or assuming it's horrible, because you know what happens when you assume, and I don't want that to happen at all. All right, the third thing is that we care about is income. Because no matter how much down payment you have, no matter how much you have in reserves, no matter how good your credit is, if you don't bring in enough dollars to make the monthly payment, how are you going to succeed in making the monthly payment? So income is critical. Now, there's lots of ways to look at income. I mentioned to Jose earlier that we look at income in lots of different ways, and I'm an expert in finding ways to squeeze out every penny of your income that we can see. But sometimes we can't squeeze it out. Sometimes you make the dollars. Maybe you have a second job, but you only started that second job 6 months ago. I can't count the income from 2 jobs until you have 2 years of consistently working 2 jobs. So that creates a challenge where you have more income coming into the household than I will let you see. A real common one is people who are self-employed. Because when you're self-employed, you have a silent partner. If you didn't know it, every person in the United States that is self-employed signed up to have a silent partner. That silent partner's name is Uncle Sam. Uncle Sam gets part of your profits in the form of taxes. And so people legally can shortchange their partner by adjusting how much profit they show on their tax returns using some loopholes. The problem is you can't win with Uncle Sam and win with the bank. And so you've got to look at how much money am I showing in profit. And right now, typically it's too late. You've already filed your taxes, but a lot of people haven't. Because of a unique situation in California, with all of the flooding, your deadline was postponed in California. And so that allows for you haven't done your taxes yet. Let me look at them if you're self-employed before you file, because that would allow me to give you advice on what you should change or adjust in order to maximize your qualification. But rest assured, even if you don't make enough income on your taxes, I have other programs. The problem is they come at a higher cost. The 3 things I'm talking about right here, your credit, your income, and your cash. Those 3 things balance each other out. So if you have great credit and great income, I can help you with cash, 0 down payment, seller credits, etc. You can get in with very little money. If you have great credit and great down payment, I can deal with the income. I've got a loan program right now that if you're putting 20% down and you have great credit, you don't need to have a job at all. Now you're going to pay a 9% interest rate and you're going to pay a lot of fees. So it's an expensive option, but depending upon your circumstances, that may be worth it. It may be necessary. That's cheaper than paying a whole bunch of taxes to the IRS. So I have creative solutions, but I don't know what you need until you talk to me. So come to me, show me everything, and then let me guide you on what option is going to work best for you. Now, the fourth thing we care about is the property. The property is separate from the other three. No matter how good your cash, your credit, or your income are, the property must meet lending criteria. Now, what is lending criteria? The first one's value, because it's got to be worth what you're paying for it. We don't want to be stuck with a home that you were the only one that saw the value because you grew up in that house and there's sentimental value. That doesn't pay the bills if you can't afford the monthly payment and we have to resell the home, or you have to resell the home, and nobody else has that same sentimental value. Nobody else is willing to pay that price. So value is important. The second thing that's critical is the condition of the property. Now, what do I mean by condition? The property must be safe, habitable, with no health or safety hazards. So if you are buying a home that's a fixer, it's okay if it's junky, it's okay if it's old, it's okay if it's run down, it's okay if it's dirty, it's just not okay if it doesn't work. So if the house is broken, we cannot do a traditional loan. Now I have other loans. I have loans that can actually include the cost of fixing up the house and making it what you want. So there's great options to do that where you have a renovation loan, but traditional loans, you can't say, hey, John, I'm buying this house as is. So don't worry about the condition. You may not be worried about the condition, but I'm the one that's loaning you $400,000. I'm going to care about the condition of the property because if you don't pay, I got to be able to resell that property. So it is critical that you understand just because you choose to buy a house as is does not mean I choose to finance a house as is. And I say me, it's not my money, it's not my decisions, but my industry doesn't care that you said it's as is. Unless you're doing a renovation loan, we can't ignore issues with the home. But there are issues I don't want to know about. Don't send me your home inspection because your home inspector is going to nitpick everything. Their job is to disclose everything that could be a little bit wrong with the house. I don't care about those things and I don't want to know. So be careful. Get a home inspection done. I think it's critical to do a home inspection. Don't put too much weight into it. It's kind of like buying a used car and getting an inspection of the used car. Guess what? The door is going to creak. Guess what? The tires are going to have wear and tear. The stereo is not going to be the best Dolby sound that's out there. It's a used car. Guess what? You're buying a used house. Things are going to be out of order. Things are not going to be working properly. I don't care, but I don't want to know that because sometimes it can get under the skin of an underwriter and they're the final decision maker and they can say, you got to get that work done. The third thing that matters about the property is the type of property. So when I'm talking to first-time home buyers and I'm doing this masterclass, it's critical for me to impress upon you the importance of understanding when you're getting pre-approved. Explain to me, or if you choose to make the mistake of going with somebody else, then explain to that lender that, hey, I'm buying a duplex, or I want to buy a fourplex, or I want to buy a condo, or I want to buy a manufactured home, because the rules are different on every single one of them. And if I don't ask you and you don't tell me, I assume you're buying a single family residence, which is the most common situation. But the rules are different if you later on say, oh my gosh, I found this great house and it's a condo. The rules are different and the down payment requirements might be different. Sometimes we can't even finance the property on a condo because the condominium project does not have the financial health that the mortgage industry requires. There's some really weird things that you would say, well, that doesn't make sense. I can explain it to you and it does make sense. You just never thought about it or understood that was an issue. So just recognize the type of property 100% matters. Now, speaking of types, let's talk about types of loans. So types of loans, conventional is a big category. You hear that loan, it's a conventional loan. Conventional really is made up of two companies, Fannie Mae and Freddie Mac. Those are two government-owned, government-run, privately held companies, but they're under conservatorship of the federal government because, well, Those two companies were blamed for collapsing the global economy back in 2008 because they backed bad mortgages and they had to get bailed out. And the government has never let them out of that bailout. They've never let them back out on their own. They've kept them under the government's control for the last 15 years. So Fannie Mae and Freddie Mac set the rules. Now, I told you could put as little as 3 to 5% down on a conventional loan, but conventional loans are sensitive. What do I mean by sensitive? Conventional loans care a lot about your credit score and your down payment when it comes to determining your interest rates. And so you need to be aware that the smaller your down payment, the harder it is to qualify for a conventional loan and the higher your interest rate is going to be. So ideally on a conventional loan, you want to have 10% down or better. Ideally, 740 credit score or better, but you can have as low as a 620 credit score. And ideally, you want to spend between 28 and 30% of your income towards your house payment as a cap. Now, technically, we can go as high as 50, but it gets harder to qualify, and you really need a good lender who can help you navigate through those waters if that's the case. The second category of loans is really what we call government-backed loans. That's an FHA, VA, or USDA loan. What I'll tell you is FHA people think is a first-time homebuyer loan. It's not. Anybody can use FHA. The only rule is you can't have two at the same time. So if you just had an FHA loan on the house you're selling and you want to buy another house and use another FHA loan, first of all, I'm going to advise you as to whether it's a good idea or not. So one of the things you'll find with me is when you come to me and say, John, I want to do an FHA loan on my new house. The first thing I'm going to say is why? And you're going to say, I don't know, because I was told to, because I think it's the right thing. It's what I did last time. And I said, great. Do you want advice or do you just want an order taker? Because I am not an order taker. I am not going to do what you tell me to do. I'm going to push back and explain to you what I think you should do. Now, ultimately, you are the decision maker, but I would not be doing my job if I just let you tell me what to do and I rolled over and said, okay, no problem. You're in charge. You're the client and the customer is always right. No, the customer is not always right, but the customer is always the customer. And it's my job to take great care of you, and I would not be taking great care of you or let you tell me what type of loan you should get when I'm the one that's been doing this for 23 years, has helped a few thousand families get into homes, and I'm pretty good at what I do. So allow me to guide you. Don't set a preconceived notion to say, oh my gosh, this is the right way, or oh my God, that's the wrong way. Be careful. Be open to ideas and be open to advice, because that's really my job. Now, an FHA loan, as I said, lots of people can use it. It's a great option. It's much more forgiving than a conventional loan. A VA loan, super forgiving because, first of all, if you're a veteran, thank you for your service. Secondly, VA is thanking you for your service by saying we're going to be very relaxed in a lot of the things that we look at. VA in most areas is more relaxed than any other loan program out there. Now, the third option is a USDA loan. USDA was actually created by, yes, the Department of Agriculture, because there was a problem with farms in middle America and rural areas where banks weren't servicing those areas, and farms could not find farm workers because they couldn't get loans to buy homes in close proximity of the farm. So the USDA created a loan program that said, hey, if you're buying in rural areas, you can put zero down payment. It's kind of like an FHA loan, kind of like a conventional loan, kind of the best of both worlds, and it's zero down payments. So the limits changed based on FHA, VA, and USDA. They're all a little bit different. Cash requirement is 0 to 3.5% down. 640 credit or better is ideal, but you can go down to a 580 in most situations, and we can take care of you no problem. And they're more forgiving in the debt to income ratio. As a matter of fact, in some cases, we can go as high as 55% of your income towards your bills. Now, the last category is jumbo. That jumbo really, I'm going to rename it because it's really non-conforming. Jumbo is loans that are bigger than the conventional limits, but sometimes it's not about the size of the loan, it's about the attributes of the loan. So maybe, as I said earlier, you're in a position where you can't count your income, or you are doing a great job of decreasing the profit so that your silent partner, Uncle Sam, doesn't get as much money in taxes, but you need to use an alternative method of proving your income. Well, then I can't do a conventional or a government-backed loan, but you're not doing a jumbo loan. you're doing a non-conforming loan. It's what might be called non-qualified mortgage or non-QM. You might hear that term. So this really is just everything else, and it really encompasses everything that conventional FHA and USDA don't encompass. All right, for the sake of time, I said I'd be about 60 to 90 minutes. I'm at 70 minutes, so I got up to 20 minutes left. And good news, I don't have that many slides left. So if you have questions, by the way, and you're on Zoom, feel free to post those. I'm going to take a quick sip of water here. Here's the deal with the mortgage world right now. It is not getting easier to get a mortgage. One of the biggest mortgage companies in the nation has built a marketing campaign about push button, get mortgage. It doesn't exist. When you go to that company's website and you push the button, your phone rings. You actually have to talk to a human being. So it's critical to understand, Leroy, I saw your question. I'll get into it in just a second. So it's critical that as you are thinking about the home buying process, understand there is a lot that goes into this. The mortgage industry has been blamed for collapsing the global economy 15 years ago, and we are continuing to pay the price. Not only that, but we're dealing with the government regulations. We're dealing with fears of a bubble. The economy is in flux. We've got a war in Ukraine. We've got major inflation problems, and it's creating lots of guideline changes. And so who you work with to do a mortgage matters more than ever. Now, I'm going to go back to Leroy's question. He had a question about income. And he said, is the debt to income ratio based on net or gross income? That's a great question. It's based on gross income. And what's really cool is some incomes are not taxable. So if you have income that's not taxable, well, that technically is your net income. That means I get to what's called gross it up, or create a pretend amount of income that it would represent to say, well, gosh, to get this much in net income, you'd probably make about this much in gross, and I get to qualify you on that higher pretend gross number. But to answer your question very directly, Leroy, we take your pre-tax income. That's why we let you spend 40 to 45 to 50% of that number, because the rest of the money has to go to taxes. It has to go to food. It has to go to clothing. It has to go to gas and utility bills. There's lots of other things that we don't include in the numbers that we're adding up. I don't care. I don't pay attention to your cell phone bill. I don't pay attention to your travel costs or how much you pay for food. So I'm saying, hey, if you make $10,000 a month, then I'm going to let you spend $5,000 of that on your credit cards, your car payment, and your house payments. That's 50% debt to income ratio. The other 50% of your money, or the other $5,000, goes to taxes, goes to food, goes to utilities, all of those other things, your cell phone bill, the things that we don't pay attention to. So hopefully that helps answer your question, Leroy. Again, if you have other questions, gang, if you're watching live on Zoom, post them right now. If you're watching live on Facebook, feel free to post them. I'm just not able to see the Facebook comments right now, and I'll circle back to them and answer the questions in writing. And if you're watching after the fact via YouTube, do the same thing, post it in the comments, and I'll come back and I'll be notified and I'll answer it in writing. Okay. So why does this all matter? Because I want you to understand the right expectations of what it takes to buy a home and what this process is going to look like. This is really very much like flying in an airplane. So if you've ever flown in an airplane, you know that the pilot's job is to get you to your destination safely and on time, and ideally avoid turbulence. But it's impossible. It's getting even worse. So talking about how the turbulence across the United States is becoming worse, and we're seeing more and more issues of severe turbulence. That isn't a bad pilot. That's not a bad airline. That's not anybody in the process doing anything wrong. It's just the environment you're flying through. And the pilot's job really is to make sure that you're not being served hot coffee the moment they hit serious turbulence. That would hurt. So that's my job as your pilot. I can't promise you we're not going to hit turbulence, but I promise you I'm going to be in the cockpit and I'll be talking you through it and telling you what we need to do. So understand, a great loan process isn't about perfection, because it's impossible for me to predict everything. It's impossible for anybody to predict everything. But where I'm an expert is I see the horizon. I'm always paying attention, but I'm really good when the going gets tough. Most lenders struggle there. They hide. They don't tell you what's going on. They hope that they can give you a better answer tomorrow, so they're not going to give you an answer today. You're not going to get that from me. All right. So let's talk about what is the process, like what happens from here. So step one is to get pre-qualified or pre-approved. I don't like the word pre-qualified. That means you've got to let me pull your credit, take a look at your income, take a look at your bank statements, make sure that you are approved and eligible to buy a home. At that point, you go out and you find your home. You need to have a great realtor to help you do this. If you don't have a great realtor, reach out to me and I can connect you with one. But it's critical to have a good realtor because they give you the advice, and sometimes their advice is going to be counterintuitive. Sometimes on one home, they're going to say offer $10,000 less. And on another home, they're going to tell you got to offer $30,000 more. And it has to do with strategy. It has to do with gamesmanship, because the listing agent's playing games too. Sometimes they underprice the home on purpose in order to get a bidding war, in order to get a bunch of people wanting to buy the same home. And then they start competing against each other and they drive the price even higher. Okay, at this moment, once you find a home, that's when we can lock your interest rates. So interest rates are changing every single day, but I cannot lock your interest rate until you get an offer accepted on a home. Now, I say I cannot. I actually have a program where I can lock your interest rate before you get an offer accepted, but it really isn't a good program. It's not a good idea because you're buying an insurance policy that's pretty expensive. And if you don't find a home within the timeline that's required, then you're actually out the money you paid up front. So very rarely is it a good idea to do what we call a shop and lock, or lock-in shop, where you lock first and then shop for a home. So just recognize that your earliest opportunity to lock your interest rate is when you get an offer accepted on a home. And between now, once it's locked, it's never going to change. Most 99.9% of the loans I do are 30-year fixed. You would have a clear understanding from me if I was talking about anything else that wasn't a 30-year fixed. So your interest rate is going to be locked in and it won't ever change for 30 years. But you cannot lock the home, and you are not locked even at the time that I pre-approve you. There'll be an interest rate we will talk about, but that's just today's rate. It's like buying airline tickets. And at the time that you're looking at the prices, you see a price today, but you don't click buy. Tomorrow, the price is going to be different. Once you lock a rate, it's locked. You can't unlock it. You can't change it. You can't say, oops, I wish I would have waited a couple of days. It's no different than when you buy those airline tickets and then it goes on sale 2 days later. You're going to call back the airline company and say, hey, can I get it that cheaper price? And they're going to say, no, when you bought it, that was the price. So it's the same thing with mortgage rates. When you lock in the rate, that's the rate that you're getting. Now, once you get an offer accepted on a home, you're going to be paying for some things. You're going to be paying for the appraisal. It's about $500 to $600. You're going to be paying for the credit report if you haven't paid for it already. That's $46 for one person, $76 for a couple. You're going to be paying for your earnest money deposit, and you're going to be paying for any inspections you want to have done on the home. Okay. The rest of the money you need for the rest of your down payment and your closing costs are paid at step number 5 when you sign the documents and you close escrow. Right before you close escrow is when you bring the rest of the money in. So once you find that home, we lock your interest rate, you pay for all that stuff up front, then we send the loan into processing. Processing is our liaison to the underwriting department, who is the final decision maker on the loan. Recognize that during this stage of steps 3 and 4, they happen concurrently, and that process can take anywhere from 14 to 30 days. They are going to re-verify everything. Now, it's my job to make sure it doesn't fall apart there by me making sure during step 1 that everything looked good. But if something changes, if you charge up some credit cards, if something changes about your income average and you start working less overtime, well, I calculated your overtime average during step 1, but 2 months later, we see that you've worked a whole lot less overtime in the last 2 months, and now you don't qualify anymore. So you've got to make sure to understand, just because you got a pre-approval, that's not a guaranteed loan closing. We're asking for everything again. We're asking for updated paycheck stubs and updated bank statements. We're asking for blood samples. Okay, no blood samples, but it's going to feel like we're asking for blood samples because we literally verify everything twice. Once at step 1 to get you pre-approved, and again, once you're in contract. Now, once you get through that process, then we get you your final paperwork and we get you in front of the notary to sign. As a matter of fact, what you'll find is that's becoming more and more of a digital process. Right now, we can do what's called a hybrid closing, where about 80% of the signatures, you can just click through on DocuSign. And then you meet with a notary to sign 5 pieces of paper. It makes the process easier to digest. You can actually review the paperwork at home and DocuSign it yourself. You just have to have DocuSigned it by the time you met with the notary. But often you can have a couple of days to review the paperwork, read through it, and DocuSign it as you're finished with each page, instead of sitting in front of a notary and feeling pressure. Oh my God, I got to read this quickly and I don't know what I'm reading and I don't understand it, but I'm going to go ahead and sign it because we only have an hour to get this finished. So we're making the process better, but it's change. And a lot of people are afraid of change. And so just recognize there's some great opportunities for clarity, but part of that comes in a lot of the signings are now going to be digital, and that you'll just meet with the notary for the final couple of signatures. The next phase is you're actually going to meet with the notary like you're meeting with me. Now that's called remote online notarization, and it currently is not available in California, but there are other states that it is available in. And in those states, you never need to meet with a human being. You can literally be on a Zoom call, and you're going to hold up your driver's license to prove who you are, and then you're going to stay on that call while they watch you grab a pen and sign the piece of paper. Okay. The next stage after that is you're going to sign on your computer screen. That's not too far ahead. So the closing process, the signing of documents process is becoming more and more digital. Once you signed your documents and you brought in the rest of your money, that's when we close escrow. So that's step 6. That's when you move into your home, you hire cheap labor and little children. I'm totally kidding. But you will move into your house. Just be aware that sometimes there can be delays outside of our control. Now, it's critical to me to make sure that I'm closing you on time, but just because it's critical doesn't mean I guarantee it. So leave a little wiggle room in the schedule with movers, leave a little wiggle room in the schedule with giving notice to your landlord on when you're moving out. The nice thing about buying a home is your mortgage payment, your first payment doesn't come until between a month and a half after you became a homeowner. So you got some flexibility that maybe you can have a couple of weeks of a layover where you still have your rental and you own the home. You get to do some painting or some work on the house. You get to move yourself in without having to make the move in a day. So don't schedule it really tight where you put your notice into your landlord saying, hey, I'm closing escrow on my house on July 20th. And so I'm moving out on July 21st. First of all, there's a chance we're not closing on July 20th. I do my best to make sure that doesn't happen. But more importantly, don't put it that close. You buy a house on July 20th, your first payment is September 1st. You prepay your rent. So you prepaid rent on July 1st, you made your rent payment, that paid for all of July. So you make the payment on July 1st, you move, you get your new keys on July 21st, and you have 9 days before you have to be out of your rental on July 30th, and you don't have any payment to anybody on August 1st. Your first payment to the mortgage company is on September 1st. So talk to me about timing. You are way better off if you leave a little bit of leeway or overlap between those 2 dates. All right, so I want to talk about, first of all, I need to take a little sip. I want to talk about the financial benefits of owning a home. People think about appreciation as being the reason to own a home is, oh my gosh, home prices go up and that's where you make money. That's one way you make money, and that's right here. So 2% appreciation on a $350,000 home means you're making $7,000 a year in appreciation, or about $583 a month. But there's actually 2 other ways that add up to even more than the appreciation. By the way, 2% is a conservative number. What we find is that typically in California, it's going up by 4 to 5% on average. Now, the average means some years it might drop by 2, and other years it goes up by 20, but you've got 4 to 5% consistent average on how much the house price goes up. And I'm just using a 2% number. Forced savings. What is forced savings? It means every single month when you make a payment, you pay principal and interest, property taxes, homeowners insurance, and maybe mortgage insurance. But the first thing I said was principal. Principal is money you are paying down on the balance of your home, which means you owe less money. So the value is going up, that's appreciation. The balance is going down, That's your forced savings. So if you bought a house for $500,000 with zero down payment, in 30 years, you'll owe nothing. Every single month, you put a little bit into the forced savings account. Even if the house never went up in value, you have a $500,000 savings account because you paid down the balance every month. Now, the value is going to go up on that home, but forced savings is totally separate from appreciation. And you don't get that when you're renting. Your landlord does not credit part of your rent towards a savings account that you get to tap into later, but your mortgage company does. Your home being an asset of yours, you get that benefit. And the third benefit you get is a tax write-off. Now, this is the more complicated one because it depends on your tax bracket, depends on your other taxable write-offs and deductions and what the standard deduction is. There's lots of different variables. So we just using an approximation and saying, hey, you might get up to $590 a month in tax savings. Now, maybe you don't wait until the end of the year to capitalize on that money, but you instead change your withholdings so that you get more money out of every single paycheck. All right, so the next thing I want to talk about is my calculator that is on my mobile app. If you do not have a mobile app yet, please scan this QR code and you'll get my mobile app. And right down on the bottom of my mobile app, you'll see the button that says calculator. And you would click on new purchase. And once you do that, then you are able to see what you can go through the numbers here. You can click on FHA and then you can look at, hey, what's the sales price? And you can adjust the sales price and it gives you the monthly payment up here. You can change the interest rate. So if you know that interest rates are 4 or 6 or 6.5, you can adjust that and you can then see what that means to your monthly payment. You can adjust your down payment and it continues to adjust your mortgage insurance automatically. So there's a lot of flexibility built into this calculator. You click calculate right down here on the bottom and it gives you a very nice breakdown of what your monthly payment is. And then it gives you your amortization and it says, hey, how much money is going towards principal? And in that case, it was $461 going towards principal. And then it'll create a nice PDF of this that you can click share. All of that comes from my mobile app. So if you don't have my mobile app, make sure to install the mobile app right now. All right, the last thing I want to cover is really who you do your financing with matters. I think I'm going to end up perfectly on the dot at 90 minutes. So why does it matter who you do financing with? Because it's a tough market. And so the reputation of your lender matters. And I have spent 23 years calling my reputation because not only does it matter that you have a great real estate agent for negotiation, but your lender will make a difference when you are in competition head to head with somebody else. One of the factors they look at, and there's a lot of them, is do we trust this lender is going to do what they say they're going to do? And I've had multiple deals where I've been told, John, your buyer won because you take great care of your clients. You do what you say you're going to do. You communicate well. And so it's all about what I do pre-offer. I call the listing agent and I tell them what to expect because I don't want them to be surprised by how great I am. I want to tell them in advance the things that they can expect so that if they're in the tough situation of deciding between one offer or the other, it's going to come to mind saying, well, if everything else is equal, that lender called me and talked through everything and told me all the things he was going to do. And so what I do ahead of time can help you get your offer accepted. We can fully underwrite your file if it's necessary. That would allow us to remove some contingencies and close quickly. Okay, so understand this is a weird market. Interest rates are high. People are saying there's no demand. Nobody's buying houses. The number of home sales is low, but that's because the number of homes listed for sale is even lower. So if you want to buy today, you're going to be in a competitive situation. You're going to be competing with a lot of other people, and you're going to be in a position where you have to decide, how do I make sure that I'm not just writing offers, but I'm actually getting an offer accepted on the house that I want? And it's about having the right person doing the right things. All right, so in wrapping up, guys, here's the last thing I want to show you. Next steps. You can download my calculator. You can go to apply.johnloanking.com or scan the QR code right here. And if you are not already subscribed to my YouTube channel, please do so. I put out a lot of content on YouTube. I've got a lot of content that I've got in my library that I'm sure you can find answers to a lot of questions you didn't even know that you had. So here I am coming up literally 8:29 on the dot. I appreciate all of you joining me tonight. I look forward to taking great care of you. If you are not already working with me, let me be very clear. This is me interviewing for the job as your lender. I would like that job. So if you caught this just by accident on my YouTube channel or on Facebook, understand I don't get paid for speaking. I get paid to do mortgages, and I like to take care of my family and be able to pay to put my kids through school. So I would love the opportunity to serve you and to take great care of you. So if you have any questions and you're on Zoom right now, feel free to post that question. Otherwise, I'm going to wrap up and just advise you, don't have a mobile app, download it. You can start the application process on there and run the calculations. And if you have not yet subscribed to my YouTube channel, please subscribe to my YouTube channel. I look forward to taking great care of you, and I hope everybody has a great night. We'll talk to y'all soon. Bye-bye.